let's talk about trading cryptocurrency futures. Okay, so this is a powerful tool for traders who are looking to leverage positions, hedge against risk, or just capitalize on market volatility. Unlike spot trading, where you are actually buying and selling the actual asset, futures trading allows you to speculate on the future price of a cryptocurrency without actually owning it. So this guide is a walk you through everything you need to know about crypto futures trading, from fundamentals to advanced strategies and tips for managing risks, and also sharing some gems about which cryptocurrency futures platforms I like to use. If you like the kind of content we do here, hit that like button, subscribe. Always head on over to our main site, decentralized.news, for the best cryptocurrency exchange reviews, DeFi platforms, NFT marketplaces, all things crypto. So let's get into what crypto futures are. In fact, these are just simply financial derivatives that represent a contract to buy or sell a specific cryptocurrency at a predetermined price at a specified future date. So traders do not own the underlying asset, instead entering into contracts settling at the expiry date. So the key futures in terms of the features of futures trading, obviously leverage, which is allowing traders to use a leverage, meaning they can control a larger position with a smaller amount of capital, amplifying losses and gains. Settlement contracts can be settled in two ways: physically, at the end of the day, with that, where the actual cryptocurrency is delivered, or cash settled as well, where the difference between the contract price and the actual market price is also exchanged in cash. And then you've got these expiration dates, where futures contracts have a specified expiration date after which the contract must be settled. So perpetual futures do not have an expiration date, are renewed continuously. Margin requirements is also something to think about, where you are a trader maintaining a certain amount of capital in your margin account to open maintain your futures position. So when we look at how the actual futures trading works, so you've got long positions, where if you're a buyer or trader who buys the futures contract, you're betting on the price that it underlying cryptocurrency is going to rise in the future. If the price rises, you make a profit. Short position, the opposite, obviously, selling a futures contract, betting that the price of the underlying asset is going to decrease in the future. If the price falls, you make a profit. And you can use these positions in various combinations, hedging existing holdings, and also speculation on market movements, or leveraging your exposure. So there are different types of crypto futures contracts to think about here. You got perpetuals futures, which are contracts that don't have an expiration date. You got quarterly or monthly futures that are set with an expiration date, such as let's say the last Friday of the month or the quarter. The prices of these contracts will converge on the spot market at the expiration date, often used by institutional traders for arbitrage into hedge against other market risks. And you got inverse futures contracts as well, which are contracts where the margin and the payout are denominated in the cryptocurrency that's being traded. For example, Bitcoin. The opposite, obviously, this is the opposite of when you are doing a linear futures contracts, where the margin is denominated in USD or a stable coin. So you can look at some of the key cryptocurrency or key exchanges for crypto futures trading. Of course, you can look at Binance. Binance Futures offers you a range of perpetual and quarterly futures contracts with the leverage up to 125x, supporting isolated cross-margin modes as well, catering to both beginners and advanced traders. Check out the link to Binance in the description. You've got Bybit, which focuses on perpetual contracts with leverage up to 100x. For something that you would want to have trading tools that are advanced or competitive fee structures, you want to probably use Bybit. The link is also down below. Then you've got BitMEX, which was kind of the pioneer of the perpetual contracts market. You can leverage up to 100x. Also has a good liquidity. You can check out the link down below. Then you got OKX, which offers a wide range of futures products as well. Perpetual and dated contracts, leverage up to 100x. So many more. Check out the links in the description. Now let's talk about the key concepts when you're trading futures. Leverage and margin, okay, something to think about, which allows you to, when you're thinking about leverage, it allows you to amplify your exposure, like I said. So, with the 10x leverage, you're a trader, you can open a 10,000 position with just $1,000 in your account. Obviously this can also increase your profits and also your risk of liquidation. So you can also have margin, which is actually the collateral that is required to open and maintain your leverage position. Okay, so they categorize in two types, mainly initial margin, which is the amount of capital that is required to open up the position, and then you also have maintenance margin, which is obviously the minimum amount of equity needed to keep your position open. If your equity falls below this level, obviously your position is at risk of getting liquidated. And then you have cross margin and isolated margin. Obviously, I've explained that shares with the cross margin, you're looking at the available balance across all open positions, reducing the risk of liquidation by using all available funds as collateral. This can also lead to a complete loss of funds if the market moves against your position. Okay, so it's very tricky to use. Cross isolated margin, of course, restricts the amount of margin allocated to a specific position. Only the margin allocated to that risk can be risked, obviously, if your position goes bad, and the remainder of your account balance is also protected. So I like to use isolated margin mostly. Things to also consider are things like funding rates and premium indexes. Okay, so you're looking at a funding rate, which is pretty much a periodic payment made between traders based on the difference of the perpetual contract and the spot prices. If the funding rate is positive, obviously long position holders pay the short position holders and vice versa. Okay, so the mechanism is just really there to keep futures contracts aligned with the spot price, and also the premium index is kind of representing that difference between the futures price and the spot price, and reflecting also the market sentiment. A positive premium indicates a bullish sentiment, while a negative premium also suggests that the sentiment is bearish. So this is something to look out for. But when it comes to the actual strategies for cryptos futures trading, obviously long strategy used by traders, when you open a position to profit on upward movements. Short strategy, the opposite. And then you got hedging strategies where you portfolio hedging. Traders with large spot positions, especially in a cryptocurrency, might open short futures positions to hedge against potential losses as well. And the contracts do protect them against that downside risk without having to sell the underlying asset as well, which is kind of cool. Arbitrage is something to think about there, exploiting the price differences between the different exchanges and markets. And obviously, for example, a trader might buy cryptocurrency on one exchange, simultaneously sells futures contracts on another exchange where the price is higher. This is kind of to profit from that difference. And then you got spread trading strategies as well, where you got the calendar spreads, involving simultaneously buying and selling futures contracts with different expiration dates, and profiting from the convergence or divergence of the prices of those two contracts as well. Then inter-exchange spreads, where you're taking advantage of the prices between the same contract that's traded on different exchanges. For example, a trader might buy a futures contract on Binance and sell it on Bybit if there is a price discrepancy. So those are some of the strategies there when you're looking at spread trading. Then you got advanced strategies as well, where you got basis trading, for example, involving the buying of spot assets and selling the equivalent amount of futures to actually capture the premium between the spot and the futures, right? Strategy is typically employed in futures trading at a significant premium to a spot price usually. And then you got grid trading, which is basically a strategy that automates the buying and selling at predetermined intervals, creating that grid order at incremental levels. And this is particularly useful in managing or those ranging or sideways markets. Okay, so now let's just talk about that risk management and wrap this up. This position sizing, okay, making sure you are doing that. You should never risk more than you're able to afford, obviously, in one trade. Stop loss orders is something to think about. Diversifying as all your positions, understanding liquidation risks, and also just using a trading journal. And some of the aspects of psychological futures trading, discipline and patience, something to think about. Emotional control and obviously continuously learning. All the resources and tools are available at our main site, decentralized.news, but also thinking about the right kind of exchanges to use futures on: security, liquidity, leverage options. These are things to think about. Some of the new platforms that I like are BitUnix, for example, PrimeXBT, which is obviously been around for a long time, but you've got Bybit, Binance, OKX, links all down below. Let me know what you guys think, and if you're a futures trader, I want to hear about which platforms you like to use. Also suggest any other content you'd like to see on this channel. Like, share, subscribe, turn on the notifications. I'll see you guys next time. Peace.